preparing for this call, a quick personal mention. I saw the news about DKK's expansion in Ghana, Cameroon, and Ivory Coast. So I guess congratulations is in order. That
Thank you.
kind of growth, especially in emerging markets, is no small feature. What's been driving the expansion lately?
I think the actual demand for our services, we started off life providing dollar liquidity. Being an ex-banker in the FX markets and looking after these regions, we knew that there was a problem with central banks hitting their dollar ceiling. And there was a real need after the global financial crisis and de-risking that a lot of the major tier one banks, their risk appetite had changed significantly, and therefore the access to, let's say, global dollar euro liquidity diminished significantly. Given that Africa, imports a significant amount of trade, FMCG, materials, construction equipment, all over the world, the need for dollars has become even more pressing. So we set up DKK about 5.5 years ago to address that need. We started off in Senegal, in Cote d'Ivoire, sort of Central West Africa, and we realized that, yeah, look, Ghana has the same issue. And again, the whole of Central and Central West Africa had an issue regarding this problem. So the plan is, obviously, once we do our fundraise, which we're planning to do at the back end of this year, is start to look at the traditional mining countries, Mauritania, Angola, Zambia, and essentially two things really. One is to provide local companies access to dollar liquidity, settle their liabilities. But secondly, international corporates in terms of repatriation of funds back to home country. What you find is that you have a lot of, let's say, mid-market companies importing wine or onions or, all sorts of other stuff, right? And they find that they can't get the money out. They don't want ZOF or ZAF or Ghanaian Cedi. They want euros or dollars back, right? And they're running an exposure liability, given that the currencies are quite volatile. But one would argue euro dollar's been quite volatile over the last sort of 4 or 5 months, right? So behaving like an EM currency. So that's what really has sort of pressed the need. And within emerging markets, it really is a FOMO, word of mouth, right? A lot of people talk amongst each other. They see that, yeah, there's a good service provider. There's someone that actually can deliver, provide good rates. We took the effort to establish ourselves locally in markets with our own local entities, which was hard at first, obviously, of course, because it's a long bureaucratic process. But being resident in these markets helps significantly. And we've seen a lot of our peers that are non-resident fall by the wayside, to be honest with you, on that. So, yeah, we've sort of ended up being sort of last one or two standing as a service.
Great to hear. Well, so just to give you a bit of the frame of the conversation, how it'll go, let me give you a quick breakdown. So what we'll be diving in today is, firstly, we'll talk about what's changing in the financial services world. Then we'll talk about 5 trends that leaders really need to have on their radar. We'll then go into how firms like DKK are positioning for those shifts, and we'll finish on some advice for staying competitive as the market moves fast. Does that sound good to you?
Yeah, very good. Happy to chat about these things with you. No issue.
Perfect. Well, can you just tell me how, because I don't want to mash it up, how do I pronounce your surname?
Talukder, as it's spelled. Talukder.
Talukder. Perfect. Well, I'm just going to introduce you and then we can dive right into it.
Okay.
So, in this episode, we're joined by Khalid Talukder, co-founder of DKK Partners, a firm at the forefront of emerging market FX, payments infrastructure, and trade facilitation. DKK has rapidly expanded across Africa and the Middle East, and Khalid brings an unmatched view into the financial systems that power global trade. Today, we'll break down 5 unsettling but critical trends financial leaders should be watching in 2025. Great to have you here today, Khalid.
Stefan, absolute pleasure to discuss these topics with you that are the forefront of an ever-changing financial services ecosystem. And yeah, thank you for having me this morning.
So, what big shifts are you seeing across global financial services right now?
I think it's something that's been happening over the last probably 3 or 4 years is the decentralization of financial services. With the advent of digital and crypto technologies becoming more mainstream, challenging the TradFi environment. Now, I'm a traditional banker and I spent nearly 20 years at UBS City and Deutsche working in the FX and capital markets. And as everyone knows, moving of money has been sort of at the beck and call of the SWIFT network, which is essentially a system created by the banks in the 70s to basically communicate with each other. The sort of breakdown of correspondent banking as well, and also moving away from the gold standard to the dollar reserve currency, really has, let's say, put a real dependency on the US dollar, especially within emerging markets. We don't see it so much in the Western Hemisphere because we can seamlessly move currency around, but within the emerging markets, particularly the markets we operate in, the African banks are dependent on a dollar nostro to do their business. And what usually happens is they probably have to go through 2 or 3 correspondents to get access to a nostro that belongs to a Standard Chart or an Eco Bank, one of the largest tier 2 banks in the region. Necessity is always the mother of invention, and a bit like telecommunications, everyone knows. And look, I'm a product of emerging markets myself. My parents are South Asian, and I grew up in the UK. But we always knew that the fixed line telephone system was absolutely appalling, right, in terms of doing these large international calls, long pauses, echoes. But you see that you get a better mobile phone signal in Accra than you do in central London, right? And it's because they've adopted new technology super fast. And what we're saying is the advent of stablecoins being used more and more as a medium of transfer of value to be able to pivot in and out and access global liquidity pools without having to go through the traditional rails or infrastructure that, yeah, are great if you're Unilever or Nestle, right, or Shell. That's not an issue. But if you're a mid-market importer of saucepans or Tupperware or tables, it's incredibly challenging to satisfy your liabilities and run your business, and therefore not put too much strain on your working capital cycle. So, yeah, I think the decentralization of traditional finance is becoming more and more prevalent. I think our use case particularly focuses on working capital and providing speed and efficiency. When people mention crypto, they think of Bitcoin, Ethereum, staking, tokenization. There are various derivatives of that. And I think people associate it more in the retail space, more so in sort of the corporate or let's say non-bank financial institution space where we sit. But yeah, look, I think it's here to stay. As long as the powers to be, and I said I was 10 years at Citibank, decide not to offer dollar nostros to local banks in markets, you're only going to get more of an acceleration of stablecoin usage to basically do business. So, yeah, and I'm seeing that explode, especially within LATAM and Africa, particularly.
Great insight. Thank you for that. So, from where you sit, do you think tech native firms are now setting the pace globally?
They were initially. Look, I'm not going to claim to be a technologist, right? I'm an opportunistic banker that saw an opportunity to combine traditional finance and being able to clear currency using stablecoins, right? I think technology has played a major role in providing the infrastructure and the rails in terms of moving value. Where we sort of, and I say the old sort of TradFi guys like us come in, is we have a intrinsic understanding of regulation and being regulated, right? At the end of the day, you're still moving money, even though it's a different form. And what I've noticed, and again, coming off the back of Token 2049 in Dubai a few weeks ago, is you've got some super smart technologists and technology companies wanting to operate in financial services, but do not have the rules of the road of understanding the regulatory landscape and environment. And therefore, you see tremendous accelerated growth and then a sudden stop because the regulators got their own. So we've got the other way. We've built our compliance and governance, and that's what you'd expect, right? You've spent 20 years in financial services. you do get the compliance injection, right? But that served us well because we add more sort of a mature perspective on understanding that the technology is here to stay, but using it in a very sort of disciplined and responsible way, and making sure that the regulators are happy in terms of the business that we're conducting is super important. Last time I checked, there isn't a tech regulator for financial services, right? There are only financial services regulators for financial services. So I think tech is now beginning to understand the sort of the tech end of the spectrum, understanding and appreciating that us TradFi guys do have some value to add at the end of the day to complement their technology. So we're not as dumb as we look, right? Kind of thing. But I think more and more collaboration is now taking place between getting involved with traditional finance orientated individuals within technology companies.
Yeah, okay, great. Because yes, as you said, you guys bring that years of experience in actually the financial markets and regulations themselves, so you guys can get and understand what you need to be compliant from the get-go, which, as you said, I guess some of them kind of oversee in the first in the beginning. But so let's dive into 5 disturbing trends to watch. So for trend one, institutions losing ground to agile fintechs. So let's start with competitive pressure. Are you seeing more incumbents fall behind because of slower tech adoption?
Look, I think everyone realizes that the big financial institutions that we're very familiar with have disparate technology, inefficient technology to even do the basics from that perspective, and therefore have fallen behind the curve, especially more in the retail sector. On all forms of account opening, credit assessment, right? Various AI tools to really truly understand the profiling of a client or a customer. And I think the banks have acknowledged the fact that they need to up their game to be able to stay relevant within these type of services. I don't think the banks, I would say, have lost ground. The banks are canny creatures, right? There's a reason that they've been around centuries, right? I think City's been around 200 years because they evolve and adapt eventually. It's just turning this huge super tanker. I think what they've done is offered some form of compliance arbitrage. Once a bank decides they can no longer lend to a client, you lose 70 to 80% of the revenue that you can generate from a client. So credit is key. And banks essentially are lending vehicles at the end of the day. We see current accounts, we see FX, we see equity. Well, they're just, sideshows, right? It's the credit guys where
Yeah,
you make money on. Since they've now identified that, look, these guys we cannot afford to bring on board because they're too much of a delinquency or credit risk. I don't feel our credit profile. That has then opened up actors like ourselves to capture these companies and provide them the services that they required, less the lending that they can get somewhere else. So I think what you're having is some form of, let's say, gentleman's type agreements taking place where banks will provide you facilities like us, but be completely arm's length and therefore generate a certain percentage of risk-free revenue through a compliance arbitrage type perspective. I think where you've seen the most dramatic trends is in retail banking, right? The speed and ability to open accounts. Revolut, for example, has completely revolutionized using, technology, facial recognition. The banks are still unfortunately having to catch up, and they're getting there. But then the bank also wants to maximize how much can this client take a mortgage? Can this client take a credit card? Can they take a loan? So their thinking is completely traditional, where the technology companies will cross-sell you experiences, money off shopping, travel, lifestyle, perks, etc., which then from a consumer replaces the need for loans, car loans, credit card, insurance, all that sort of. In fact, sorry, Revolut actually offering on insurance through AIG. So yeah, I think banks have really fallen behind how to cross sell to a client away from traditional products and services. I think the industry that I think led the way was supermarkets with Tesco Club Card, profiling, identifying customers with data, and then understanding exactly their habits when they're not in the bank or they're not in the supermarket, for example. But I think, yeah, look, banks will always be what I would call the motorways, the infrastructure. They're just going to have less cars, right? The cars are going to be replaced by the Teslas of this world or BYDs of this world, right? And less Ford, less Renault as technology evolves. And I think that's where we'll get to. I think, Stefan, we saw the same thing with IBM, right? They sort of moved away from producing computers to more mainframe and
Yeah.
infrastructure because they realized that we can't compete with Dell, right? We can't compete with, some of the other brands like Apple, for example. So yeah, I think the banks didn't like it at first, right? Because they're very proud entities, but they've now recognized that, yeah, I think the pond is big enough for both entities to coexist and benefit from each other.
Great answer. So for trend two, FX and cross-border transactions getting squeezed. DKK is a leader in cross-border FX. Are margins tightening? What's changing in how firms think about global payments?
Yeah, look, I think due to the globalization uh, of businesses and individuals, the acceleration of moving money cross-border has become incredibly exciting and prevalent. And when we say moving money cross-border, let's face it, you're moving dollars, right, or euros mainly. If you're making disbursements local currency, yeah, there are also local payouts that need to be made. Um, there's always going to be pressure on a commodity. FX is a commodity at the end of the day, right? It's like bottled water, and there is a fear that if you don't have economies of scale, you become inefficient. But we look at it differently because we offer a time saving via FX, right? Due to the infrastructure we've built. When I say to people, when you use Uber, you're not ordering a taxi, you're basically buying time, right? Because they're basically doing the hard work for you. It's like, why do you have to service your car during the day? Do it at night when it's sitting on the driveway and doing nothing. Someone picks it up. People will pay premium for that. And I think for the markets that we operate in, speed is key. Where typical settlements cross border, you get a great rate, better than us, but it settles 5 days later, right? Because what's happening is that the trader is basically waiting for the market to move such that they make their margin in a traditional way. Let's face it, right? They look at the graph and go, right, this is time to trade. That's no good for a corporate or a mid-market company wanting to satisfy their liabilities, right? They need the money T0, T+1. So where we may be, say, a little bit away from, let's say, some of the more sharper pricing, what we have done is enhance the value experience by speed and delivery and settlements. And I think settlements is going to become more and more important than just price at the end of the day, right? There's a reason that there's a DHL service rather than the normal post service. There's people that are willing to pay for speed and urgency. And especially in markets where everyone knows traditional banking system within emerging markets is very clunky and a lot of friction, it would bite your hand off for speed. Now, what will then happen is that you get more actors like us coming in, offering the sort of stablecoin clearing solution to complement the cross-border FX, right? And that will start to compress margins down. Of course, that's healthy competition at the end of the day. And then you add all the other aspects in terms of client servicing, facilities, being able to partner with various other entities outside of your scope, such as trade financing or lending, etc. So it becomes you're selling an ecosystem rather than a commodity at the end of the day. I think some companies get too hung up on the Swift fee or the FX spread rather than focusing on, well, actually, the most important thing is the delivery and the time at the end of the day. And if you do a survey, clients are more interested in rather having the money tomorrow than rather having the money next week, but paying a little bit more for it.
Great. Yeah, I think you really hit a spot there that it's truly, we're really living in a world where speed matters and people will, no problem, pay that extra premium just for that sense of urgency. But so to dive in trend three, clients want instant personalized services. Let's talk about client behavior. Our expectations shifted fast, especially with Gen Z entering financial decision-making roles.
Yeah, look, I come from a generation where we still like enjoy going to the shops and buying stuff, right? The new generation are, let's say, more demanding in how they spend their time and see these type of activities as non-value add. So we are getting more and more, and it filters through from retail into the corporate space, right? As the Gen Z start become business owners themselves and start to take over these companies, that time is one of those commodities that you can never get back or recycle, right? So therefore, why not give the control back to someone on how they spend their time rather than being at the mercy of a system that you lose a day, right? If I can give that day back for, let's say, 20 transactions you do in a year, that's 20 days back for you to do other things that are more value adding. So that trend, I think, is going to become more and more prevalent and it's here to stay. It's just the fact that Amazon Prime, Uber, Netflix, instant consumption and demand, um, not, tolerating standard services that absorb or consume time that you can then do more value-added things like learn a language or, do stuff with your family. The things that are important to you, right? At the end of the day. So I think it's more of a societal trend, to be honest with you, that manifests itself throughout the whole of the, let's say, commerce ecosystem. But look, I think technology has definitely helped in the way that services are consumed and delivered. There are probably a couple of other areas that will start to embrace. I think education is one, to be honest with you. Instant consumption through your TV or point of entry. Necessarily, do you need to go to school in a classroom? Obviously, there's a benefit of interacting with other pupils, but yeah, look, I think there's a paradigm shift and it's changing. And if it's not recognized correctly or not embraced, the market will just ignore you, right, and leave you behind.
It's funny you mentioned education in one of the what you see changing, but so I don't know if you follow a bit about what's the talking about in the AI space, but that's exactly right on point. One of the first biggest changes we're gonna see apparently is going to be in education itself.
Mm.
So for trend four is compliance isn't keeping up. So regulatory environments are evolving fast. Our legacy compliance systems holding firms back.
Yeah, there's always been this issue that regulators are constantly playing catch up for technology and new methods of transferring value and transferring and protecting information. Um, I think it also is down to the fact you have to look at the personnel that currently reside in these institutions and they don't have enough technology or new venture focused or fluent individuals within those organizations. If you've been chopping a tree all your life and then all of a sudden you ask that same person to start fixing motor cars, it's going to take a while, right, for them to catch up at the end of the day, right? And that's what you find at the regulator. I think technology, reg tech companies that are starting to educate the regulator in terms of bringing efficiency, the principles and values don't change in terms of the rule books that are produced, in terms of guidance and the way that KYC, AML, all the standard compliance and governance structures reside, right? At the end of the day, it's the delivery mechanism, or it's the way that clients consume products in new channels, which is a bit of a headache and a challenge. And I think it comes threefold. I think one, yeah, the staffing at these institutions needs to start employing people from regtech companies. I think two, policy, any type of policy, any type of legislation always is incredibly bureaucratic, right? But then you can use an AI agent, to your point, basically start producing draft policy probably in half the time for it to be reviewed. So that is embracing policy in a good way. I think third also is we are still stigmatized, or the regulator is incredibly still, let's say, post-traumatic stress disorder from the global financial crisis, right? Where they are terrified that consumers will lose their money and they're not doing a sufficient job. And, this kind of psychological barrier that they have, that they cannot go too fast too quickly. Now, I think as you've raised the point, as more Gen Z and after those start to fill these positions, they'll be a lot more open-minded and not scarred from the events of the past. We've had 2008, 2010, 2012, right, where the regulator is seen as someone that protects the individual and companies and failed at their job. So they are incredibly paranoid still at the higher echelons of cocking it up, right? And therefore, that is the handbrake on, which is psychological. That will change, and that's a time thing, as more, let's say, open-minded individuals regarding technology and the benefits it brings to the ecosystem to complement and enhance TradFi. But yeah, you're right. It's an inertia at the moment, and it does hold a lot of things back. Where you have jurisdictions, and I can speak from my own experience, such as the UAE and Dubai, having a single person at the top for decision making really helps, right? In those type of things in terms of speed. VARA, for example, was a regulator that was created 2.5 years ago for digital assets, at the decree of the ruler of Dubai, right? And it just got done, kind of thing. This is important. This is strategic. Of course, there are pros and cons to that type of approach, and then there's a lot of, let's say, retrofitting later on. But it gives you the ability to play and actually observe and understand how the market operates. In the Western Hemisphere, we always lead with policy first, technology second, right? At the end of the day. And that's something that I think will need to change, because there's a real danger that emerging markets will start to overtake facilities going forwards from traditional financial institution space.
Thank you for that. So for trend 5, risk perception is changing. In emerging markets, especially, risk used to be about volatility. Has that definition changed?
Well, I mean, when everyone talks about risk, you probably talk about 3 types of main risks. One is market volatility. One is settlement risk, to make sure the clients settle you correctly or banks settle you correctly. And the last one is counterparty risk, is actually who you're doing business with. And this is the source of funds, right? At the end of the day. I think both the counterparty risk and the market risk are quite sophisticated from that perspective, from sort of the AML, KYC, hedging the actual currency. I think you're always going to get economies that are incredibly sensitive to currency devaluation, with hard currency leaving the market. That basically engineers the volatility. And then the central banks not having enough levers to control things like inflation and interest rates as well. So one would argue, right, at this point in time, the Bank of England, the ECB, and the Fed are completely misaligned, right? So in our own G3 world, we're seeing amazing. Look, the current administration in the US, I think, is trying to behave like an emerging market, or trying to create the G10 as an emerging market basket. But look, once things normalize down, which they'll do, I think due to the intrinsic nature of the markets themselves, the zero currency devaluation, you're going to get that. I think settlement risk is key. And I think one of the challenges we always have we done sufficient checks and backgrounds on the individuals or companies that we're working with in the market, given that we're blessed in the UK to have Companies House, right? An electronic database, you can look stuff up. There's no such thing in Senegal. There's no such thing in Cote d'Ivoire, right? But there's opportunities, good businesses there. So what do? Well, we look to companies such as Deloitte and EY that can do vetting for us in a more sort of, let's say, traditional method. But this is why I think AI comes in, right? And AI can effectively give you that kind of reassurance that, yep, these guys or these counterparties are good to do, good to go with, right? Look, at the end of the day, if someone wants to walk into the road and get run over by a car, you can't stop them, right? If they want to do something silly, they'll do something silly. But for us, I think market volatility will always be, unless they peg themselves to the dollar, or Central West Africa pegs themselves to the euro, for example. But yeah, for us, I think it's settlement risk and knowing the counterparty and the governance. And then that goes back to your last question regarding regulation, governance, and controls, right? We operate in a market that is challenging from a regulatory and compliance perspective. We know that there's only so much we can do, but I think combining questions 3, 4, and 5 in terms of what you've been discussing this morning, yeah, I think you can mitigate, but you cannot eliminate.
Mitigate, but not eliminate. I like that. Well, so for DKK's response and lessons, so how is DKK adapted to stay ahead of these trends? Are there systems or practices you've put in place to stay nimble as you grow?
I think from bitter experience is actually making mistakes, right, and not trying to make those same mistakes again. I think for our perspective, you cannot treat emerging markets with an Anglo-Saxon mindset, right? I think that was our biggest Achilles heel. We thought we were still operating as a Citibank or a Deutsche or a UBS, right, with our clients. And obviously, emerging markets, there's a lot more informal communication and networks that goes on. I think the way that we have managed it is having people on the ground and creating trust with the regulator, being present. A lot of the type of companies that operate in our space don't have local presence. They probably have non-presence entities. So therefore, they don't really have skin in the game. And I give you a great example. Before we got our VARA license in Dubai a couple of months ago, yeah, look, they all know where I work. They know what I do, what I'm trying to achieve. But there still was some hesitancy, like, but you're not going to stick around, right? You're just going to go. As soon as you get the license, they go, oh, so you are here to say psychologically. So I think having that kind of investment, and it comes down to people at the end of the day, even though you can do all the technology, all the infrastructure, it's that trust element. I'm yet to see AI simulate trust because I think that's a human thing. At the end of the day, people feel comfortable. The fact that you're here, you're present, you have an office, you have people on the ground, you're here to respond to queries. We're very mature in having business deals done over Zoom, done over, WhatsApp or, Telegram or whatever, right? But they have to press the flesh still. That's not just Africa, that's also Middle East as well, right? They want to meet, they want to see you, right? So I think the lessons learned for us is that if you're going to approach emerging markets, there's a human capital element. You cannot automate that bit. There's a relationship aspect. You cannot automate that bit. And I think going forwards, we will just reinforce our commitment to be a significant and long-haul flight player rather than a fly-by-night entity. There's a real fear of flight risk that people give you their money and then you then disappear and they never see you again. But yeah, that's what I would say is probably my biggest observation is more so having the commitment on the ground, having a recognized legal entity that is local, and having local people within your organization work with you to push your business.
Yeah, okay. So at the end of the day, it's about building trust and maintaining that credibility. So your advice to financial leaders, what would you say to financial execs listening who feel like they're falling behind?
I think the first thing they need to do is listen, right? They need to put their ear to the environment and see what's going on. Look, I personally may not be the right target market for a lot of the technology changes that are going on, but it's what the market wants at the end of the day, right? It's not about how I feel. So I think industry leaders, if they're listening to this, is that we need to listen. Financial services leaders are very bad at listening. we're just bad. We're very reactive, right? Something goes wrong, we need to put something in place, right? And they're very good. They're going to project mode, but they're not incredibly proactive in embracing what's going on and understanding societal trends, the way that companies do business, information is transferred cross-border, the advent of new technologies coming through. I think the second thing I would say is it's very easy to say this, but don't expect to make profit on day one. Invest, right? You need to have investment up front, a sunk cost. You can't get away from it. If you want to succeed in the markets that we operate in, be prepared not to have any revenue for a year, right? There's no instant gratification, right? Which is a paradoxical, because obviously if you are of a generation where you do have instant gratification, that's going to be quite challenging, right? At the end of the day. So I think that's the second thing that I would say as well is be prepared to invest time, people, money, resources. Understand that you cannot apply Anglo-Saxon mindsets to certain markets. Observe and understand the cultures, be incredibly respectful. But last of all, be one of them, right? At the end of the day, yeah, you're there to enhance the economy, enhance the ecosystem, allow them to do things that they were never able to do before. And then you find that you've got their trust, you've got their buy-in, and then they do protect you if something does go wrong in the market.
Great advice, Khalid. Well, this has been an incredibly sharp, and I feel like we've hit every trend. Could be a podcast on its own. So thank you for being so generous with your insight, Khalid.
No, look, absolute pleasure. And look, I do hope that some of the messages and the conversations that we've had this morning resonate and people can take benefit from those and use them in their own worlds going forwards.